With that, I would like to ask Marcos Hernandez on the stage. Marcos is our CIO, and he's a partner at SIA, and he's with us since 2007. He has been at Merrill Lynch for many, many years as a sell-side analyst before he managed an internal value fund on the trading floor with Nostra Money of Merrill Lynch. Floor is yours.
Thank you, Alex. Thank you. Okay, thanks for coming. It's very happy to have all of you here. I'm going to start with a little bit historic recap on value investing. So it's not really kind of something that you can study in the university, but value basically starts in the beginning of the 20th century, 1920s, 1930s. So one of the leading intellectuals there was Benjamin Graham, money manager over there, and also professor in the university. So there's many people around value. Value is not only Benjamin Graham, but I think Benjamin Graham is one of the top names to highlight here. He wrote a couple of books, Security Analysis in 34, very dense and very technical. In The Intelligent Investor near 1950, which is much easy to read and very recommended to read. And he states everything that we're using now, intrinsic values, margin of safety, and how to deal through the financial statements. Many people have followed this school. So Buffett was an alumni of Graham, Charlie Munger, Walter Sloss, Brown, Tweedy Brown, Julian Robertson, Greenblatt, even there's a Spanish famous Paramés. All these guys and many other that I'm missing here have been following the value school. So just a word here, beginning value was very kind of quantitative and easy. So these guys were through the pink sheets, looking to numbers and looking at cash, looking at book values, low PEs, and very easy because opportunities were abundant then. And they were making good money, but this doesn't last forever because the market is now much more efficient. So market there was in the beginning, and now it's more complicated to do this type of stuff. Just one sentence from Graham, to see how deep his thinking was. In the short term, the market is a voting machine, momentum, and in the long run, it's a weighting machine. So really, in the long term, what counts is cash flow and prospects, how strong the company is. Second message for me, value works. So I've been able to go to the MSCI World Value. So this is an index built by these guys. This index only starts in 75, so I couldn't go earlier. But if you take 50 years, it's a 9% annual growth. So value works. It's a 9% per year is a good performance. If you take longer data and you look at the market globally, the market does 6-7%. Since the beginning. So the global market, global equities, you can expect 6-7% per year. This is natural because it's close to GDP, nominal GDP growth. You cannot really grow much more than what the world grows. And very long-term trends, sorry. So 20 years of value cycle, 74 to 97 more or less, with 2 points of outperformance versus growth, 2 points per year, which is a lot. And then in the last decade, from 11 to 2020, 10 years of growth, as George was mentioning. So we've been there, the value guys, we've been there waiting to see this momentum fading, and we think the momentum is fading now. Let me decompose value in two different aspects, but this is only one lens, one approach. There's many approaches, but there's a quantitative value, or discount to intrinsic value, which is really easy to make. Is in the beginning. So this goes to Graham, to Warren Buffett in the beginning. You take the financial statements, you calculate an intrinsic value, which is very easy. Basically on historical margins, on historical numbers, sorry. You can even build DCFs, net asset values, apply market multiples. This is a pure quantitative analysis. But then, over the years, over the decades, to value has been coming a kind of a strategic analysis, qualitative value or competitive analysis. So here, I think the perfect example is when Charlie joined Warren Buffett, and over the years, the cigar butt philosophy of Warren evolved towards buying quality. So there's a mix between value and quality. So here, the difficulty is that numbers are very clear. Everybody loves maths. Everybody loves complex models. And when you see an Excel, fantastic, you think the IRR is this and the valuation is that. And the qualitative analysis is much harder to pass. You know, when you're saying this company is good, why the analysis is less strong, you have no number. But in our opinion, qualitative is as important or more than the numbers. Let me see it on a different perspective. So I have another way of seeing value would be dividing it in two, even three. So what is pure value? You take the traditional numbers or historical numbers, so then you don't have to imagine anything about the future, be agnostic about the future and value the company on the past 3 years. So basically this is very easy. You apply a low multiple of the results of the past 3 years or the price to book, you buy the cheap stuff and you wait. So this is basically the beginning of value, and this is Warren in the beginning was doing basically this. Then there's another step when you can converge value. What is converge value? Converge value is you look at the past and you look at the highs and the lows and you try to see what is going to be the average for the future. So this is what we call mid-cycle or converge valuations. So you can calculate an IV, which is a bit more, it's the next step of pure value, and you try to see where the company is going to grow X, 5 or 6%, this company, the margins are this or those, and the returns are this or that. And then you can even do a quant. So if you are, you know, an IT competitive guy, you can model pure value and you can model normalize and converge value, because all of these are numbers. Even converge value, you can take the past and you can calculate the average and do the future, and a machine can do it. So this is kind of the traditional, in our opinion, value investing. And this is what we think is the final step, is our makes difference between SIA and other value guys, is that we add a strategic layer to this value concept. So we analyze the sector, competition, entry barriers, historical returns. We have been able to even to find regime changes. So when you find a sector which is returning very low returns, and then something happens like concentration, the sector changes, and then returns move up. This is the way to make really big money. Find sectors that are changing, also to lose money. To find sectors that are changing the regime. We discard. We really don't touch weak business models. We learned this in 2008, 2009. So we don't want bad businesses because they have a lot of negative options that end up materializing. And there's a big misconception in our opinion. So obviously we buy good businesses, and the big misconception for us is the neat split between growth and value. There's a clear overlap in growth and value. So we value companies assuming this or that growth, and we buy at a discount, but we also can buy growth companies. We have Visa in our portfolio, and Visa is a growth company, but this growth is very visible. So we are able to pay higher multiple, and for us, is a discount to intrinsic value. And this is a problem. This is, in the end, all this is very, very nice, but the important thing is the execution. What this means is that the important thing is within the bucket of growth or within the bucket of value, if you are good selecting companies. So you may be value, you may give me growth, whatever you are, in the end, you need a good analysis, you need execution, you need discipline in the due diligence, apply a discount, talk to the companies, as George was saying, talk to the suppliers, think again and touch the numbers. So it's really, the execution is key. Then you need to choose the stocks, right? We are stock pickers here. Value is difficult because we are always a bit contrarian. Normally, companies are cheap when they have a problem, and we try to understand if this problem is just short-term or structural, and this is the key. If the problem is structural, we can buy. If not, we don't buy. And again, luck is really important, and it has an impact here. Just moving to SIA funds, you know us, so we are a small boutique based in Lachen. Value, obviously, long only, no strange things, small team, 8 people, 4 investment professionals that have more than 25 years experience, everyone. And the Classic has returned a 9% annual for 20 years, 10% return for the last 10 years. So this is our target. We don't want to take too much risk, and we think we can do a 9 to 10% per year. Investment philosophy, very easy. We look ourselves as long-term investors, entrepreneurs. We split the investment in two ideas, capital preservation and decent return. We don't want to lose money. We are very concentrated, so we cannot really make mistakes. We try not to make mistakes. We are the kind of guys that if the stock goes down, we buy, and we buy, and we buy, and we buy more and more. So we cannot really have a mistake in the fund because it can be very, 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 very painful. And in the end, we are always looking at good businesses and trying to buy them at a discount. Our principles, very easy, I go fast, good businesses, good managements, you know. We've been we've seen many times how a bad management, not focusing what is important, can do to a good management, and it's not good things. Long-term view is the only way, sorry, you can take one idea here from today, is long-term is the only way to invest in equities, long-term. Even more than 5 years, because you know things tend to materialize over the long term. Circle of competence. This is obviously core value. The right price means discount to intrinsic value. We do our strategic analysis, which we think it's a little bit different from other people. Obviously, we do financial analysis, so we do IRR and intrinsic value for every stock we have, and then we can calculate what is the IRR and the IV for the fund. So we are able to tell you if the fund is cheap or not, where the trading range historically has been, and we are very transparent on that. So we are very disciplined. We don't speculate. We don't think if the market goes up or down or recession or not. We have our view and we try to transmit our view, but we don't care. The book is prepared for downturn and we will survive. We don't do leverage. We hate leverage. We don't do derivatives and other funnies. So it's very transparent and quite boring, to be honest. It's a kind of holding. So how, couple of minutes, if I may, on the portfolio. So no index, fundamental analysis. The weight in the sectors depend on opportunities, so we don't track anything. We are fully invested and very concentrated, 30, 35 companies in the classic. And basically, yeah, we don't change that much, but we are very diversified by currencies, by geographies, by businesses. So even if we have only 30 companies, if you look through the companies, we have maybe 10 or 15 different sectors. And this is a bit different, Sia, from other people in value, is the way we build the portfolio, which we want to be very, very resilient and cross recessions. So for us, category 1 is risk-free. Category 1 companies are kind of risk-free. Nestlé, Unilever, McDonald's, Coca-Cola. You build a basket of this one, and it's easy to calculate what is the return. If they have no problem, normally they trade at an 8% return, which is dividend yield plus growth, more or less, okay? And to that, we add layers of discount. So category 2 would be very solid companies like Salmon Farming or Devro that we will present today. These are potentially Nestlé's, but on a second level, we ask for a 12% entry. Then we go to category 3 of risk, which would be cyclicals. We want 14% return to buy. This means buying below 10 times earnings. Category 2 would be buying below 15. Category 1 would be buying below 20, more or less, okay? And then category 4 is high risk, and here we want a double. Normally, we never have more than 10% in categories 4 because risk is something that the quant guys will tell you that they can value. Risk cannot be valued, okay? Because if tomorrow the government puts a tax on oil, I mean, nobody can value that ahead of time. Very important, the watch list. We come across many ideas every day. Brokers, friends, everybody's giving us ideas. And we are very, very strict and disciplined. We have a watch list, 300 names, all the sectors global, and this is our entry point. And it's an entry barrier for the book. Means new idea goes there if it competes with the rest of ideas. If we like the sector, if we like the idea, it goes there. And then we follow this thing for, I don't know, 1 quarter, 2 quarters, depending, because we are, you know, very experienced people. Some of the companies, we know them for ages, but it goes there. Any new thing goes there because new things are risk. So risk goes to the watch list. We need to, you know, look the quarterlies, hear the management, talk to everybody before having an opinion, and maybe we miss opportunities there. I'm going to stop there. 1 minute. Okay, then, yeah, because I think this is an idea that maybe is also makes us a bit different. Value investors normally struggle a little bit with commodities. We've been in the commodity space for forever, for 20 years, and we've been learning the hard way how this works. And now we think there is a combination of opportunities that is unique. Let me summarize in 3 ideas. 1, we have been underinvesting in commodities, both energy, metals, all of them, for a decade almost, since 2013. I think the peak was 2013. So heavy underinvestment for the past 7, 8 years, 9 years. Second, we are doing an energy transition, which means that we need to rebuild a big part of the economy is using electricity and, you know, taking fossil fuels slowly out of the equation and investing in green energy. And this will have a huge impact in the impact, for instance, in the demand of copper or lithium or nickel. And the third one is now the problematic with Russia. So Russia is a big producer in terms of fossil fuels. It's between 10 and 15% of the world. So 10% oil, 15 gas, and also they produce 5 to 10% of most of the metals. And I'm not touching about refining, so huge refining industry. So these three things are making that the cycle now has a very bright future. And, you know, we set up another fund, which is called the Natural Resources. This is the combination now. So we invest in equities. We apply the value style to commodities. And we invest in equities that produce this kind of stuff. So now the portfolio is 40% oil, 10% gas, and you can see the rest. So it's 1/3 is in basically nickel, lithium, and copper. And this is the way we try to add value. So scarcity, we avoid the mergers because the mergers in the end, the reinvestment pace is in lower marginal return. Good reserves, good assets, safer geographies, near production. We don't like startups because you can lose everything in a startup, in a mining project. Good balance sheet, very important, and good managers. And yeah, basically, I wanted to touch about intrinsic values in commodities, but it's too complicated. I think we can go for the Q&A on that.
And we will have, anyhow, in September, our Natural Resources Day on that topic.
Yeah.
Thanks a lot, Marcos.
Thank you.